Welcome back to the channel, guys. I wanted to do a follow-up video around the £1,000 investment I'd done in COII, the IncomeShares Coinbase ETP. Now, part of this was to do an experiment for the community and for myself to understand the dynamics of investing in these ETPs. Are you better off owning the underlying? Normally the answer is yes. Can you still come up on top with these types of investments? So I thought it would be a bit of a fun exercise, and I shared it with the community. I wasn't planning to originally. I decided to, and then everyone seemed to like it, so I kept it going. And so for those of you that are unfamiliar with this, as I said, it's £1,000 that have gone into the IncomeShares Coinbase ETP. I did it in August the 5th exactly. I bought 333 shares at £1,000. Its current state is £329. Total cash dividends received is £352.79. And my net yield is 317. We will talk through this part of it just to get people up to speed on where we're at with it. From a month-by-month perspective, now I won't revisit everything I covered in the first video, so if you haven't seen that one, go back and watch that one. But what you will find now is, now that we're in April, if I drill into the numbers now, we can see a pure coin value would be £586. This is where things start to get interesting. Last time we were up ever so slightly ahead of Coinbase, the underlying. Things have dramatically changed. We're actually considerably more up on a percentage basis. We're 9.6% up owning the ETP versus earning pure coin. Now, obviously, in terms of the monetary amount is quite small. It's £96. But I do want to point out the fact that we can actually see that while the erosion has occurred within the NAV, the actual dividends and distributions that are coming in are offsetting some of that. And they're actually making it such that we're actually better off owning the ETP right now than we're owning the underlying. And this is partly because the underlying has spent quite a bit of time going sideways, has had spikes up, it has had some drops in that period, but it's also had a lot of sideways movement. So they've been able to, during those sideways movement weeks, make good recovery on the amounts. So I think it's really important to show here that these ETPs can outperform the underlyings in certain market conditions. And actually, the NAV erosion side of things is, yes, it's important, but obviously if the income is outstripping the erosion, then you're fine. You're okay from a total returns perspective. Now, the thing that happens a lot with these brokers are they don't show you a total return. So unless you really are looking at that or calculating that outside, either with Snowball or some kind of tracker or even a spreadsheet, you're just looking at pure price return, which can make things look a little bit scary. Now, I have added one other box into this particular section around the strategic strike. We know about the 25-75% split. Most of you are familiar with that now. You are aware of the volatility buffer that it provides. You obviously are aware of the recovery lag that occurs with option strategies. But I did mention on a previous video around the fund having a major change on the 10th of March, where they did an official announcement that they were going to do some hedging. Now, my understanding is that the hedging hasn't officially started yet. But what has happened is that a lot of people complained around the fact that distributions had dropped quite a bit this month, despite the fact that there was more volatility in the market this month. And then I reached out to Octay, and he confirmed on X on the 2nd of April that the fund managers were retaining a proportion of the options premiums inside the NAV rather than distributing 100% to help stabilize the share price. Now, you can look at this in two ways. One way you can think, okay, they're trying to help with the NAV erosion aspect. If you were just after the pure income and you didn't care about so much about the NAV, then you'd argue you want to have the full distribution. The only thing that kind of concerns me with this right now is they haven't quite disclosed the strategy behind this particular strategy, which is how are they actually deciding how much to hold back and when. And so that's probably the only bit that's like concerning. I think it's okay if you're a long-term holder of the ETP, but if you're not, then you may just want the full amount. I don't know what the right or wrong answer again with this one is. I think they're just trying to listen to feedback of people complaining about the NAV erosion, and they're just trying to find another strategy to try and offset that. I'd love to know in the comments, guys, whether you're on board with this hedging or not, or them having this free reign to hold back distributions. Very interested on people's take on that one. Understanding the NAV decay, wealth transfer, and return of capital is really important. I talked about this also in the last video. Again, I don't want to revisit this, but I just want to make people familiar with what Coin is predominantly trying to do, which is sell options and harvest that extrinsic value and then pay that as income. If we were to look at this at a pure end state perspective, we can see here that actually we are doing better now owning the ETP than we are Coinbase. When Coinbase goes on a rally, it's unlikely that will stay that way, but it just shows there are ways to get your money back with these income investments and ultimately use them in the right way. And so over this 8-month period, the 1K investment suffered a 31.8% net loss. There's nothing hiding that. While the fund has delivered a massive £352 in dividends, it wasn't enough to offset the 67% collapse in the fund's capital value caused by capped upside strategy and underlying asset drawdown. However, the extreme yield creates a unique long-term dynamic, which is if Coin continues to pay out at aggressive rates, it will take longer, maybe 14 to 60 more months for cumulative cash dividends across that £1,000 mark. However, the bottom line for me is that COII is not a buy and hold growth asset, it's a cash flow engine. You're accepting severe capital erosion in exchange for massive monthly payouts, and the ultimate goal of the strategy is to hold until you recoup 100% of your initial investment strictly through cash distributions. Once achieved, whatever capital remains in the fund becomes technically house money if you don't reinvest. Now, I don't know whether the hedging strategy is going to impact this final statement now, because I think they are looking at these things as more of a long-term view, and they see people holding these more long-term, and that's why they've got some of this NAV preservation. Now, not everybody agrees to that. Again, let me know in the comments whether you do or you don't, but I thought it was worthwhile doing this update back to you because I think it's important for people to see the numbers and understand it. Again, you can pause the video at any point to look back at the numbers. As I said, I'll continue to do these if you want me to. Let me know again if you want me to continue this series. I don't want it to be overly complicated or a massively long video, but I do just want to share how this can work out in the real world.